I want to know. I'm Rick Bensignor. Today is February 7th, and welcome to this week's In the Know Trader Show. We've got an interesting show this week, and we're going to focus on, in our trader education portion, this idea of having an edge when you trade. And I've labeled this, if you don't have some type of edge, you'll lose money most of the time. So we're going to talk about this whole thing about having an edge and how important it is when you trade. And the almost assured results of pretty consistently losing money if you don't have an edge in the market. And I'll give you some examples of what an edge looks like, and especially, more importantly, what not having an edge looks like. And then we will quickly go through the top 10 names in the S&P based upon the highest weightings in the S&P. So, of course, Apple's the number one cap-weighted name, and it goes all the way down the list to United Health, which is the 10th. Just to give you an idea, the top 10 names in the S&P represent 25.5% of the total S&P, right? So if there are 500 names, the top 10 are getting you already a quarter of the S&P. Just 26 names gets you 40% of the S&P, and 45 names, less than 10% of the entire S&P, gets you 50% of the S&P. So we'll take a look at these very commonly traded and held names for what their charts show. Before we do that, let's just get to what products I offer to In the Know Trader clients. We have a weekly tactical trader report, generally comes out on Thursdays. This gives a very good macro overview of all the different markets that are affecting the stock market. So we're talking about the U.S. 10-year bond market, credit spreads, the dollar, often gold. And then we'll do a deep dive into the S&P too, giving you all the key levels you need to know in any of those other markets, as well as my view of the S&P. That is the weekly tactical trader report. Sorry, to add to that, I also put out a new ETF trading idea each week, go through all the prior open ETFs, ideas that we have. So all prior positions I'll walk through each and every week until the position gets closed out. I also have a monthly 7-11 Spider Sector ETF report. The goal here is to outperform the S&P by being in no more than 7 of the 11 macro Spider sectors. We have handily done that historically. And here's some results just to show you. Last year, the 7-11 report outperformed the S&P 500 by just over 600 basis points. That's just over 6%. We outperformed in 11 of 12 months. The first month this year of January, we did not. In fact, we had our worst month as there was a major rotation across the sectors. So we trailed this month. This month being January, the first month of the year. And in total, in the 30 months that I've done this report, we've outperformed the S&P by about 10.2%. That is still a very, very high level of outperformance. Realize that very few people outperform who are benchmarked to the S&P. We'd still be in the top decile of all portfolios that attempt to beat the S&P while being invested in the market. You cannot compare beating the S&P if you're not in the market itself. And there are many, many funds out there that tell you that they beat the market, but they're trading other products, or they're just fractionally in the stock market, and they're in other different types of investments. But being in the market 100% of the time, 100% invested, just simply not across the entire 11 sectors, is what we aim to do and get you the type of results we have. Watch my weekly webinars like this on YouTube. You can subscribe to my YouTube channel if you go to youtube.com/inthenowtrader and then click on the subscribe button. Please do that, as well as follow me on Twitter, and my handle there is @inthenowtrader. So let's talk about this idea here of having an edge. And what am I talking about? I'm talking about that the process that you use to trade has to give you an edge relative to what the rest of the market is potentially looking at. Otherwise, you don't have an edge, and your likelihood of consistently making winning trades gets greatly reduced to the point that you probably end up losing money. As it is, trading is a difficult game, and you'll talk to professional traders, and they'll all tell you this is not a piece of cake, and anyone who does is completely BSing you. It is not simple to trade. However, if you have a process that has back tested over time to give you consistent winners relative to the risk you're taking, and you can learn how to manage your risk, then you have a better chance of not just making money, but potentially even outperforming. Traders don't usually think of their results in terms of outperforming the market, but they do in simply making money or losing money, and how much of that. So I've said many a time that unless you are a professional trader, that 80 to 90% of your assets should be invested for the long haul. And if you want to play with 10 to 20% max of your total investable dollars, because the likelihood of making money over time trading is not particularly high. And I'm not saying it can't be done. It certainly can be done. But you've got to have real process, and you have to have an edge. You have to have something that puts you looking at the market in a different way than what everybody else is doing. Because if you do that, or better said, is if you don't have an edge, if you're looking like other people do, it's very hard to get ahead. So if you do the obvious stuff that everybody else is doing, you have no edge. You're playing with everybody else. And generally, the bulk of traders don't win by using models or indicators or things that everybody else is jumping on. There's very little edge when you do that. So let's take a look at some examples of what I see put up either on social media. People send me their research all the time. So here's something I saw, I think it was today or yesterday, and somebody puts this post up on Twitter, who's in the stock market and likes to post a few dozen times a day. If you started with $10,000, you'd become the wealthiest man in the world in a month if you could just find a stock that moves like Best Buy every day and stake everything on it. Clearly, a little tongue-in-cheek here, just given the outsized move to the upside and the fact that obviously Bed Bath & Beyond got some funding in order to stave off going bankrupt. But there's no edge in something like this. It's all after the fact. And yes, a little tongue-in-cheek, but generally there's nothing to what this person consistently puts out. It's what everybody else sees. Here's something else. GM, the volume will not be denied, breakout sooner or later. That kind of means like it'll go up sooner or later, or it'll go down sooner or later, or it'll do something. They've drawn, some basic trend lines. They've got some moving averages that mean absolutely nothing. Price moves above and beneath them consistently. They put up a trend channel that they break down into a midpoint. Nothing particularly helpful there. And this type stuff that, again, you see all over the place in market newsletters, in social media postings, is absolutely zero edge. There's nothing that you get from this that you couldn't do yourself, that anybody looking at the market couldn't do. And in fact, this is actually kind of wasted time and effort, because there's no value at all to something like this. And if it does break out to the upside, gee, could you not have drawn this downtrend line to see a potential breakout? Wasted time and zero edge. Here's another one I saw. So this person also posts all the time, and there's more horizontal lines here. I mean, can you imagine? This is the spider, and this is their analysis, identifying levels that at some point were a high or a low. You think there's an edge in this, or saying tomorrow will be interesting? Useless information. Here's another one from somebody who's very well known and loves to use horizontal lines and Fibonacci retracements. And this one's kind of, I find, very amusing. So back earlier in the year, or virtually at the very end of December, I'm not sure exactly where this lines up to, but they're telling you about trying to potentially bottom fish Tesla here, somewhere at around 120. And they're saying the 120 price represents a big level. So is this something you want to be short? Definitely. But I would, if this closes above 122, that's your confirmation that there's a low in place. So we want to be long above 122 in Tesla if that occurs. So this gets a close at 123, which means that person paid 123 and change, and then it drops, and we're not seeing this here because this was their post at the time, then this drops down to the low at 102, meaning that they had a 17% drop from where they got you in, which is more than enough to certainly take you out. Nobody's hanging on for 17%. And then, of course, Tesla's turned around and moved well higher since then. So this week they're telling you, or maybe it was last week, they're taking victory laps on this trade, which fell 17% against you before it even went one day your way. And no mention of the fact that that occurred. Is there any edge here? None at all. This is just poor use of trying to tell people that they supposedly have an edge because they know where Fibonacci retracements are. If you think this is an edge and you're going to put money into the market based on that, then you are assuredly going to lose money and do so fairly consistently. And this person puts out, not a newsletter, but an email to people purely as marketing every day, but puts out recommendations in this email just to have them in front of you all the time. And I know this guy, and I'm kind of sorry to see it, only in the sense that when this fell, no mention that he had gotten you in at 123, no mention of anything until it happened to have come back, turned around, and then ultimately went higher and then goes, oh, yeah, remember how we got you into Tesla? This is not what you want to be looking for. There's no edge in this. And though this person has lots of subscribers, this is the type of stuff they're getting. Horizontal lines and Fibonacci retracements telling you that this is the pure answer on how to trade because of their 20 years of experience in the marketplace. Excuse me. So that's kind of the stuff that's out there that is trying to sell you as if they have an edge. Now, take a look at this. The question again, does this provide an edge? Does it look familiar? It should. It's one of the charts that looks like a Rick Bensinger type chart. And this has a cloud model on it. It has DeMark sequential on it. It has propulsion. And so far, that's all we have. That's without doing all the stuff that other technicians do that learn, the basics of technical analysis. But if you look at, for instance, where these 13s come in, and I didn't invent this model, but I know how to effectively use it and incorporate it into how and what I do in the markets. So potential upside exhaustion sells down for straight down for a month, and it takes multi-months before you break above there. Baseline low from the cloud. Baseline low from the cloud. That coming right off of another upside exhaustion level that holds support just like it had the prior time. Baseline low, that's 3 times now. 13, again, upside exhaustion signal. Baseline low for a week, boom, gone. After the 4th break, gone. We sell off, go to top of cloud and propulsion exhaustion level. Turn around rally, baseline high. New low into a 9 down, bottom of the cloud, baseline high. Sell all the way down to propulsion not full exhaustion, just propulsion exhaustion level. Turn around, rally, get a little bit above the baseline here, stop against the bullish propulsion level that never gets a proper buy signal, therefore a fade. Down to new lows, downside exhaustion, just like these are upside exhaustion, downside exhaustion, rally to the baseline. That's now the 4th rally to the baseline. Pull back, holds propulsion exhaustion level, doesn't make a new low, turns around, and now last week breaks above, at least suggests a test up here, which is so far, again, where we're stalling against the bullish propulsion momentum level. This has an edge. This is the way I look at the markets. This is what I try to teach you, and you'll notice there's a consistent theme here, which is fading market moves at the right time and place as compared to 99% of technicians out there who simply try to play the current trend. And many of them get chopped to pieces and get you long something, and you're right for 2 days, and then you're wrong for the next month. They have no sense on how to be able to tell when trends are likely ending in multiple different time frames. And the most successful traders on the street are the ones who tend to go against the grain. Certainly the best hedge fund traders out there are not playing trend, they're playing anti-trend. And they do that because you have the best risk reward when you do that as compared to playing deep inside of a trend. What we do gives you an edge, and whether or not you follow an in-the-know trader client or not, I will suggest to you that having the type process that lets you buy low and sell high consistently is the way that you're going to make money over time. Playing the trend in the direction of the trend is going to have you have much larger drawdowns and will make it far more difficult to know when. Let's just say, here's an example. Let's say you bought, this is chart, by the way, of the QQQ. Let's say you had bought back here in January of 21. And you're buying, you're deep in the trend, and this looks great, and Wall Street targets are higher, and everybody's saying the market's going up. And a week later, it happens, we make another new high for the move, and then we fall, and we fall from, I don't know, where is that? Let's say almost 340, we'll call it 335, and this falls down to 300. That's a 10% drawdown while you're in a trade. That's very tough to deal with. That's more than almost any trader would tell you to risk on a trade. And so you get stopped out only to see a support level hold and then turn around, make new highs. You go, darn, all right, I really messed up that one. Let's get long. And again, most technicians are going to say new high. Okay, buy strength. And now you buy it again and it falls right down again. This is how you run into real trouble, and then all of a sudden you're selling out, and now you're selling right near the low again. That is not the way to trade, and most technicians don't have the tools to help you through this because within technical analysis, there's some great things, and there's also some really bad things about how people are taught to do things. I'll just go back to again say this is what we do is a much better way of trading because we have an edge. What we are doing is almost always, not 100% time, but almost always opposite what the public's doing. And that gives us a huge edge. So that's what I'm going to tell you about having an edge. You need to have one in order to play this game and survive over time. Okay, let's go back and now let's just take a look at, as I said, we're going to go through the top 10 names in the S&P. We're going to go through them quickly, and we're going to start with Apple. So here I have Apple preloaded. So you've got a downward channel, but notice some interesting things. 9 right near the all-time high, 9 at the bottom on the pullback, led to this 13 at the bottom of the channel. I can't tell you I've been bullish Apple. I've been fairly neutral to, I've actually sold some upside calls, which may be taken away, but I sold them for a very hefty premium, so I'm okay on that. This still hasn't broken out above its weekly cloud top. You can see we got a week ago, we nudged through it, but stopped at the propulsion exhaustion level. This certainly could creep higher, and then the question will be what happens, when and if we get up near 170 or the upper 160s, and whether or not this breaks out to the upside or stays in its channel. Microsoft, double 13 side-by-sides on the bottom. Good bottom there. No reason to think at this point that we're taking that out. Some resistance just above where we're trading now. Then you've got the August high to deal with, and above the August high, just above there, is the top of the weekly cloud at, where's that, 295 or 295, 296. But with a W pattern here, along with both of those having 13s at the bottom, this does look like a decent near-term breakout, but it's going to have some trouble. This is going to have to really blast through the bottom of the cloud and the propulsion momentum level here on the upside in order to change this. So this is where things look good to near-term, and traders, excuse me, unfamiliar with some of these models, but I would say it's a tough buy up here without some type of pullback. Amazon. This one I got long myself at 90 last fall, and right around here against the 13 stop out level. So I have held on to this. And this week's low, the conversion line 3 weeks ago, conversion line low. But notice we have a baseline high. I give it a slight upward bias here. Still needs to get through its downtrend line, which we see comes in somewhere around 125 or so, give or take right now. That would be the next target up there. Okay. Next is Google, and this is GOOGL. There are 2 of them that are in the top 10. They actually, when you take the 2 Googles together, or Alphabet, I guess we need to call it, they actually move well up in the top 10, even higher than they're listed, because their combined weighting is, I think, puts it in number 3, actually. So here's the downtrend line. We've just popped through it this week. That's good. We have a disqualified bullish propulsion level. No, I take that back. That is not, that is propulsion exhaustion level. We're through that. So that actually suggests we're heading next towards 110. It's at 107.60 right now, so not much more on the upside for a target, but I can make the case this gets up to at least potentially play with the bottom of the cloud. So one of the better names we've looked at so far. Berkshire Hathaway Class B shares, one of the big weights in the S&P, double bottom 2. Price broke the cloud, the lagging line didn't. This is one of the better charts. Now dealing with the cloud on the upside, had an evening star pattern a few weeks ago, but it looks like it's getting some conversion line support. This is kind of your transition level right in here. In fact, here, if I just show you quickly with a rectangle, you can see multiple highs against these near-term lows. So this is kind of the area, nothing to do in here, but watch for a breakout towards the upside here. This could be good, and that would, if we got that, that actually could suggest a test of all-time highs. The other Google, GOOG, the other class of shares, they're going to look very, very similar. Actually, I'm not going to spend any time on them, but they are Again, it is officially a separate ticker within the S&P. NVDA, this has broken through its downtrend line, as the S&P, as the S&P has. Let me just draw it and we can see where it showed up. So we actually at the beginning of January got that. Now you can see we're against the propulsion full exhaustion level. If it pushes higher, look for some resistance just above 240. We'll call that 243 at the top of the cloud. From there, it certainly could pull back towards the bottom of the cloud, but this is looking at least decent. And then a lot of these names what they're doing is taking away medium-term bearishness that's been there without necessarily at current levels suggesting that you buy them. Tesla. There's the move down in Tesla that we talked about. By the fact that, let's see, if I see a 12 here, I'm guessing that aggressive sequential probably caught the 13. Oh, it's actually early. So I didn't do anything with Tesla. I would have at least known if I was short, I'd be covering at 107. But I didn't particularly buy this name. It's got a good bounce going. Disqualified bullish propulsion level up. Look for resistance now from 208 to 220. Exxon, name number 9, looks different than anything else, as the energy sector has been a stalwart winner for the last year and a half. It's been under some pressure recently in relative terms. This is still kind of playing with these stop out levels from these 13s, and even though we're above it, it hasn't properly broken out yet, and we're on a 7 towards another 9. So even if we get up towards 118 from the current 115 or so, 118 and a half or so is potential resistance. General, though, the best looking of all these charts is this is basically lower left to upper right. And the last one is United Health. Last couple of weeks, notice United Health on a 9 down against the bottom of the cloud. This is a potential long trading idea with some defined downside risk. Sorry, tail end of a cold and cough. This is a name you could think about buying, but what you wouldn't want to see is a move under. So this is 476. I would just consistently watch the lagging line over time for a potential breakdown. And of course, the lagging line is going to follow exactly what price is doing. But it is trying to make some type of case here against, and not so far from, if we look at, let's say, where lower, prior lows have been going all the way back to Jan of 2022. This is in the neighborhood of there. So potentially a long, a small position long here. If the market continues higher, then maybe this comes back and plays with the upper end, and it's just a range trade. But risk reward, not a bad thing to probably nibble on. That's it for this week. I hope you enjoyed the show. I'm Rick Benson. Thanks for watching In the Know Trader.